All right, we have reached the top of the hour, and that means we are going to bring in Tech Trader as part of our trader profiles. We tend to do this around the noon hour in the Eastern Time Zone, 11 Central, and we bring in these traders that are recommending, maybe not recommending trades, but offering part of their portfolio and trading strategy. And today we're going to feature Tech Trader Sean Udell. Good morning, Sean.
Morning. How are you doing?
I'm doing okay. So as you know, we have new listeners. And so what we're going to do to start off with is just give you the opportunity to give them a sense of your background and your trading style. And we'll do that before we jump into individual stock names, because I do want to get to some updates on some of the names we talked about last week and whatnot. But first and foremost, I'm going to give you a chance to do a little talking about yourself. So go ahead.
Okay. Yeah, no, happy to. So, you know, I'm pretty sure there's a bio. In fact, I know there's a bio in the system. So I'm not going to just regurgitate that bio. I think one thing might be the most helpful is to kind of talk about maybe the 3 or 4 or 5 things I did or I've done that I think give me a unique perspective and definitely an edge in doing what I do pretty much for a living for approaching a decade now, which is by and large just trading and investing in technology stocks. So those, you know, again, I have a pretty comprehensive background and, you know, worked for an array of professional companies, industry-leading companies and things like that. But yeah, here the first 2 things, and if you want to jump in and ask me any questions about these, fire away. But I think the first 2 things that give me a unique perspective and an advantage is I've worked for both publicly traded and private technology companies, and I also work for probably 2 of the largest private companies in the world at their respective times. And in doing so, or those jobs were, I was largely in or mostly in the Treasury department, excuse me, of those companies. And Treasury has, I would almost say within any particular company, especially a company that's pretty large, I would say the Treasury department probably has the most cohesive view, the most broad view of the company. They deal with everything from, you know, all the hedging for the company, all the financial risks that they measure and monitor and hedge for. They don't just deal with the accounting of the company. They also deal with the, you know, everything that makes up the cash flow, the balance sheet, cash flow projections. It's also the group that works with the Wall Street folks. It's also the group that works with any stock option plans. It's also the group that works with any bond deals, and you name it, right? So, and that's pretty much all I did in, you know, before I'm kind of doing what I'm doing now for companies. When working for a paycheck, I call it. So, you know, I've seen pricing models for public and private tech companies. I've seen the differences between publicly traded and private pricing models. I've seen the differences how those companies act. And then the other part of what I did for those companies is for whatever reason, I had a lot to do with kind of what is big data now. Back when I was doing this 15, 18, 20 years ago, it was more database design and database analytics. But I was involved in teams that would basically choose at one point the buzzword was multi-dimensional database analytics. And so, in fact, I think for 3 different companies, I was part of the team that actually brought in advanced data analytic packages to companies. And one of those companies I was involved with was Visa. So Visa was a private company at the time. It's publicly traded. Everybody knows Visa now. I actually brought in a program helped bring in a program called TM1. And I actively designed the database for TM1. And just to give people an example, and this is kind of what got me going on software way back when. So give an example, they used to have a couple databases that would run, and the run times were anywhere from, 10, 12 hours. Some of them would have run almost a day. Well, so this TM1 design database engine that we used and deployed literally crunched in 20 minutes what formerly used to take 14 to 20 hours. And, that was a huge eye-opener. And by the way, I knew that stuff existed, but I never seen it in action, let alone be part of the database design of a product like that. So I think that that perspective is kind of invaluable, because first of all, not that many people have had my background in that regard. So then the other two things I would say I do, one, I've had my own businesses. So I was a broker. So a lot of people I don't think understand what being a broker, being a financial advisor really is. You're basically standing up your own business inside of a larger company. And, if you don't do well, you're gone. I mean, after I think a year, 18 months, there's no salary from the company anymore. So that gave me a perspective of seeing, okay, so how do some of the largest money managers and some of the largest companies in the world manage money? And now what do retail folks do? What are the drivers for retail decision making? So I've kind of seen that perspective too. I've seen what drives the retail investment decision process, and I've seen what drives literally some of the largest companies and the largest pension plans, and what drives their investment process. And then I kind of wrap it all up with somehow, some way, I don't know how I got interested, but I got interested in finance and trading. One of my parents might have had something to do with this, and maybe a teacher somewhere along the way. But I was probably reading about Warren Buffett and reading Warren Buffett's annual letter to shareholders probably at the age of like 8th grade. I think that was about the earliest. And one of my favorite things to do all through high school, I'd go to the library, and I literally just pull up and read all the Berkshire stuff, all the letters to shareholders, and then books on Warren Buffett. So, I mean, I basically knew about Graham-Dodd valuation analysis, and I mean, I knew that stuff cold turkey before I ever even had a college accounting course. And so then, kind of over, again, probably a 20-year period of time, I've kind of taken a Graham-Dodd valuation fundamental analysis approach and applied it to technology investing. And it's worked really well. And, I've done a lot of other stuff. I've kind of applied some of the big data stuff that I know-how that I know, and applied that to technical analysis. So I do a ton of work in technical analysis. I actually think sentiment analysis is probably more important than pure technical analysis. But suffice to say, I mean, me and teams of programmers, basically help develop the technical analysis and sentiment analysis system that I use. It's my own system. I developed it. I paid people to help me develop it. And I've been using it off for the most part for about a decade now. So, that's kind of it. I don't want to spend too much time on it. And again, there's a bio there and some of the specific companies I work for, I'm sure I mentioned. But I think kind of those four factors: one, the public and private factor, working for public and private companies; also institutional versus retail investing; and then again, if there's a fifth kicker, it's kind of knowing about very intensive data analytics, business intelligence, big data. What is AI now? It's funny, what everybody calls AI now. Companies were doing that in the early 90s. They just didn't call it AI. It was basically probably analysis of the data that was coming out of the multidimensional database that they just installed. It wasn't really called AI, but it's basically all the same thing. So, it used to probably just be called scenario analysis. Then it became business intelligence, and now it's AI. But that work has been done for a long time by the really good companies out there.
All right. That helps me segue into the overall market in general, because I know you do apply a lot of your own sentiment measures and whatnot, and considering we got a pretty hefty pullback in the NASDAQ today, I think it's a nice opportunity to get where we are as far as your sentiment readings, because I'm looking at a triple Q chart as my NASDAQ proxy, and you can see we had that where I imagine we would have just where your levels would indicate just terrible sentiment down around the Christmas Eve lows, and here we are with a nice pullback and put in a what we'll call for now just a swing high on Friday after that run up. So where are we as far as where your technicals indicate your sentiment technicals or your sentiment indicators are?
Yeah, so again, I was extremely just like crazily bullish near the lows. I'm personally sort of neutral right now. I actually think this market, kind of my view was sort of for most of the last 4 or 5 weeks of last year, my view was that the out of consensus call would be the call that probably works the best this year, and the out of consensus call was that there's probably more upside to the market than most people think. As far as where we are right now, I think 3 days ago we talked, or 4 days ago we talked, and I kind of said, you know, we're getting pretty hot. I mean, basically, we're really overbought short term. Sentiment readings are very high, so they literally were like 1998, 08, 2008 type lows in late December. That's how dire sentiment got. And again, we literally had only seen some of those readings a handful of times in the last 30 years. And so, you know, that was kind of a classic, you know, crazy low. I can't say we've come up too much, but what I can say is we might have kind of come up too fast. And so now we have to digest this. In fact, I posted a chart earlier today of basically the NASDAQ and the S&P pretty much in the same technical picture. They rallied all the way to the 100 EMA and almost did it. I mean, it's like this is an extreme V move, you know, V bottom, V move. Mm-hmm. So 100-day EMA resistance, and you know, I think I put a chart up on the S&P. So something, you know, I don't know if we're going to retrace to 2625 or 2600 or 2550, but kind of those latter 2 points, I would not be a bit surprised if we kind of at least retested that. And there's some markers on the chart for that, but we literally came up and we kissed the trend line. So the trend line that you can draw from the top, the September October high to that spike November high, and we literally touched that high or that trend line, and that was the high on Friday, and we sold off today. By the way, I also say, you know, and this is, I can't prove this because I don't have the data. I should keep data on this. I can't keep it on everything, but basically Davos is going on right now. I can't remember the market ever trading well during Davos. It doesn't mean we'll be down every day, but this is also very reminiscent. It just seems like we get a sell-off almost every time Davos comes around. So that's just kind of more of a funny coincident thing. But yeah, no, I mean, we're kind of in a perfect time and place for at least a short-term sell-off, pullback, whatever. Interestingly, just this morning, sentiment's cooled a lot. So this is kind of all we need, either a day or two that's really sharply down, or 2 or 3 or 4 days which are kind of moderately down. But yeah, this is the first decent pullback in sentiment that I've seen. We've kind of been hanging on to stubborn sentiment highs for roughly about 4 trading days. And that's kind of typical. You know, sometimes, you know, the sentiment doesn't ring a bell. Some people think some of the charts, nothing in my mind rings a bell. But sentiment usually kind of hits a top or hits a low, and then it kind of needs to digest it. People kind of need to figure it out. And there's there's anywhere from kind of a 48 to a 72 hour kind of effect, and then that really elevated or really negative sentiment reading seems to kind of work. And it worked, man. Sentiment stuff worked. Like I say, I like sentiment more than I like chart levels and things like that, because sentiment works almost 100% of the time. It just doesn't work maybe at the precise moment people think it's going to, or they want it to. But it works. I mean, again, every time we've seen a sentiment reading like we had on December 24th, we've never had a point where the market doesn't rally and rally a lot. So, you know, if we ever get a sentiment reading like that again, I'm going to say I'm extremely bullish again. Until that doesn't work, and again, it almost has to work though, because it just kind of coincides also with, you know, sort of a massive capitulation in stock prices, which is what we had at the end of the year. So I don't think we've had a reversal at all. I don't think we've had a complete reversal of the capitulation. We just had sort of what I call kind of a pretty good healing process that's reversed some of that technical capitulation.
All right. So with that said, I want to circle back on a couple of names that we talked about last week, and in particular, TEAM, ticker TEAM. I don't know how to pronounce it. Do you know?
Is that Atlassian? Atlassian, I think, yeah.
Okay. So you highlighted this one as a potential short, and all things considered, if you would have used a $100 limit order or something right around there, you could have gotten short, and you'd be sitting pretty right now. But
oh yeah, it would have worked great.
But I suspect that that's not exactly the way that you put this one on. So why don't you walk us through the actual event, and since we had earnings, I believe, what was it, on Thursday night, and then we had a pretty dramatic response in the stock with a pretty wide 10-point range on that particular day. How are you looking at this one now post earnings? TEAM.
Yeah, I mean, I think if somebody did this, they could probably stay short. You just use a trailing stop now on it. But I mean, this one was kind of a textbook. I mean, for me, I already had it lined up, and I already had it lined up on fundamentals. It's one of my, I don't know exactly how big my coverage universe is. I say it's about 300 names. It's probably a little bigger than that. And then the kind of the in-depth analysis is probably on something in that 200 to 300 range level. But of the software names I follow specifically, it's like one of the four most expensive stocks. You know, AYX would be another one as an example. I mean, there's a few of these, but the bottom line is, you know, so the fundamental setup was there pre-report, and then they had a good report. I thought they would report well, but and then I think the short entry was just basically letting them report, letting them spike up, and that they never went above the after hours high. So that's not something that's unique to me. A lot of people use that. So stock never retook the after hours high the next day. After hours is 103. I think the high of the next day was 100. But it kind of just gave up the ghost. I mean, it just kind of started fading. So you didn't, you know, any decent kind of intraday trader really could have caught that one. Netflix kind of set up the same way. The only difference is Netflix didn't have a good report. I actually thought Netflix was going to have a good report, and they actually had not a very kind of a poor report. They had a poor guide for sure. So that was another one that would have worked. In fact, you know what I'll say about Netflix is I actually don't think that's gone down very much. I think given the number, now some people said the sub numbers are really strong, and maybe they were, but you know, if that's the case, well, I would think guidance might be better, things like that. But I mean, that really hasn't dropped that much. Now, talk about a stock that probably deserved to be, you know, deserved kind of the downside that it took from, you know, the low to mid 400s to the mid 200s, and you know, was one of the biggest gainers. Period. I mean, I think they had a 40% rally. I think some of that rally was, and by the way, I did, you know, I should have been long that. I should have been long that. Let's say 250, 255, even as late as 260. I wouldn't have carried it for 100 points, but I should have stayed long. I should have got long and stayed long. At least, I don't know, 40, 50 points. I missed that one. But yeah, it's kind of surprising to me that it hasn't really dropped as much as I thought it would have dropped given the report. And as you know, for newer people, you know, I was really negative on FANG most of the last year. I said pretty much all the corrections. We had 3 major corrections last year. I pretty much said every one of them would be led by FANG, and they were. And I kind of think this year is going to be the same. And basically, as long as there's still a prevalent dip buyer in FANG, the FANGs will cause people to suffer. Until people move on to the new leaders, whatever those new leaders are, I think FANG will be a really tough trade for people who remain, you know, overly bullish on it. I think if you let it get to extremes and let it get to an extreme low, there's definitely good trading opportunities there. But I think the people who are still real bullish on FANG, just like they were last year, you know, kind of ignoring all the warning signs and certainly ignoring, you know, extreme fundamental overbought or extreme fundamental overvaluation readings. I think that's, and in Netflix it's still extremely expensive. So it's, let's say it's 80 points below the former highs. That doesn't really cure their extreme overvaluation issue, in my view. The only FANG name, and Google was never an expensive FANG name. The only FANG name that I kind of think went from being, you know, crazily overvalued to now pretty reasonable is Facebook. And you and I've talked about Facebook. I could have easily been long Facebook. I just have other names I prefer. But, you know, I would not call Facebook an overvalued name anymore. But 220 plus it certainly was.
All right, one of the things I did want to ask you about, and I think you apply this to your trading a little bit. Several weeks back, you and I talked a little bit offline. I think we even mentioned it on air once, that you have a bunch of prop trader friends who were predicting the crash heading into the beginning of this year, right? And I think you were, if I remember correctly, using that as somewhat of a contrarian indicator. Hey, here's a sentiment amongst some of my peers here, and I'm really leaning towards the opposite way. Since we've seen that rally, have you heard any chatter pick up on where we are as far as their particular sentiment?
Well, they got a lot more bullish as the stocks went a lot higher. So, yeah, we rib each other all the time, but I mean, the joke was, I was bearish, and again, this is not like a hindsight 2020 call for anybody that's new. People have been reading, listening to me, reading my stuff for the last couple of years. It's all out there. I mean, I was bearish on FANGs before they sold off. Each of the 3 times before they sold off. It's well documented. And so yeah, I mean, I was increasing shorts June, July, August. We've talked about that a lot. So I was kind of like, hey, I'm getting shorts in these chat rooms, and there's zero interest. Around November 15th to December 15th, it was all doom and gloom. These guys, it was like, oh, this is this is going to be worse than 2016. Oh my God, it might be a 2008 type scenario. I literally was laughing. I was just like, there's no recession coming. So now they're at least with me now that there's no recession. But if we have three or four down days like this, they'll probably be back in the recession camp. I mean, the thing is, we all rib each other. These guys though are paid to trade short term. So they're paid to change their mind, and they're paid to have a very high conviction for very short periods of time, right? And most of them keep their jobs because they're good at changing direction when they need to, or at least before it's too late. So some of the skills I have probably wouldn't work really well if I was, but I do a lot of short-term trading myself. I don't post much of that stuff, but to me, you can have an overriding view in a market call and then still trade and still trip. And as you've seen, I mean, I'm pretty adept at switching. I mean, meaning, hey, if Twilio, I love that name when it was cheap. Oh, Okta, I love that name when it was cheap. Those are both former longs of mine. And then once they got crazy high, I don't like them at all, right? So for me, it depends on the valuation of something. I just don't fall in love with the name. I don't marry names. But I do try to have an overarching view of the market, and I did think the pessimism on, there was about a 2-week period in December that you might as well wrote in a recession for next year. You might as well written in, earnings declines for, the bulk of U.S. companies. And again, people basically kind of got crazy, lost their mind, and sort of basically believed something in the short term that probably is an extremely low probability event. And that's what always happens at extremes. The same thing happened at highs. I mean, there was a particular few-day period, at the end of the summer where, if you believe the market, you believe that, every cloud stock was going to double again in size in the next 18 months, and the U.S. economy was going to grow just as strongly in 2019 as it did in 18. Well, again, I always say you got to kind of pay attention and avoid. I call it avoiding the same side of the boat trade. When everybody basically jumps onto the same side of the boat, they're usually not right. So whether you want to use the Warren Buffett term and call it lemmings, or when you want, I like kind of the same side of the boat. By the way, last year was all a bunch of those trades breaking. So I think at one point, didn't we have the crypto trade, and that might have been 17. Anyway, but we had the crypto trade break. That was kind of exemplified at the end of that trade by Riot and Alphin being super highly valued companies. That I shorted Riot. Then we had the VIX trade, right? The perma short volatility trade. You know, a lot of guys talking about how that trade's worked for years. Well, that trade blew up on everybody. That was also part of one of the first two sell-offs. I can't remember if that was the January or the February sell-off last year. And then really, again, FANG declined in all three of the sell. But the third big drop was really the same side of the boat on FANG, and probably highly valued cloud names too. So yeah, I mean that's probably why I pay as much attention to sentiment extremes as I do. Because hey, I'll ride the trend, but when you get super extreme on sentiment, that means that the trend doesn't have very long to last anymore, and that's both to the upside and the downside. Now, that doesn't mean I can't own a stock for multiple years. I've owned Apple for multiple years, Google for multiple years, Twitter for multiple years. So, you know, I can hold a stock a long time, but as far as the market view, you know, I definitely pay attention to those sentiment extremes. And some years, you know, the tougher years, frankly, are years where the sentiment doesn't really go to extremes. And we have plenty of years like that. Frankly, I think those years are harder to navigate, at least for me.
All right, so you threw a couple new names, not new names, a couple of updated trades on the radar in Redfin and Overstock. I want to start with RDFN because you already added to this one, and then we'll touch on Overstock in a minute. But this one is down, let's see, it was down significantly earlier. It's still down, 9%. So trading below your level that you thought was really juicy around that 1690 area. What are your overall thoughts on Redfin right now, particularly as we've had some so-so data coming from the housing market?
Yeah, well, okay, so first of now, that level, I thought that was pretty juicy for a trade. Still do. It's a little lower than it was. I mean, the stock hit, and this stock kind of excites me because it hit such an extreme, in my view, undervaluation level. So whether it's the November low or the December low, notice, by the way, that if somebody pulls up a chart on this, they did not break the November low. I'm not going to say all the stocks I like or favor are stocks that the November low was lower than the December low. But you know, it's interesting. Probably about half the stocks that I really like right now, they actually put in a low in November, and the December low did not exceed that low. So you know, take it for what it will. But you know, Redfin's actually probably one of the more exciting names for me, and here's why. One, it's right in my wheelhouse as far as companies I think I can understand and have an edge in, understand like what they'll do, how they'll grow, how big they'll get. Just as some background, so in 2013, two companies I really liked, and I wasn't writing for Briefing, I was writing for somebody else at the time. It wasn't one of my own products, but it was under somebody else's umbrella. But I basically said that Splunk and Workday would become huge companies over time. And you know, I won't get into all the reasons for it, but suffice to say the call was a pretty good call. And basically I called each of those companies category killers. And I thought they had, you know, very, very easy to identify competitive advantages. I thought they had very long-tailed growth. By the way, both companies are still essentially growing at somewhat similar growth rate. The growth rate has ebbed a little. But really, Workday and Splunk have maintained a very high level of growth, you know, maybe even longer than I thought they were going to, because this is like four years beyond that time. I would say Redfin is about as close to a company as I can find that kind of meets those categories. You know, first to market, or it's first to market with their spin on the product. I think it's a category killer. It's an intermediator. It's a price intermediator. It's very differentiated. I think it's going to be hard for people to copy. Now, so then you add to that. Now, some people don't like Redfin. It's been kind of disappointing. You know, some people would look at that chart. I think that chart's beautiful, but some people look at that chart and call it a terrible chart because it's not in the upper right corner of the chart. It's in the bottom right corner. I kind of tend to prefer stocks in the bottom right corner, at least if I'm buying them, if I'm accumulating. Well, once I've owned them a year or two or three, I definitely prefer them in the upper right corner myself. But no, I mean, Redfin, so you have a classic case of a company. By the way, this was a unicorn. This was one of those private Silicon Valley unicorn companies that actually came public early. I like that because they actually let the public markets have a chance to experience the growth of the company before they become a 40 or 50 or 80 billion dollar company, right? Like I would have loved it if Airbnb would have gone public 4 or 5 or 6 or 8 years ago, but they didn't. They stayed private. So that's going to be a much tougher company to make money on when it comes public. But the only thing really plaguing Redfin are two things. One, it is going to be cyclical with real estate because they're in the real estate business. So it doesn't mean they won't take share. It doesn't mean they won't keep growing. Their growth rate's been very good. You know, this is a company that even last year in a pretty slowing housing market, probably put in something like 30% year-over-year growth for the full year. Maybe a little bit more than that. So somewhere in the neighborhood of 30 to 35%. But they are in the real estate space. And so what happens in real estate when, one, housing prices have been rising for 4 or 5 or 8 years, and two, all of a sudden the Fed comes back in the picture, right? But again, to me, these things are not, they're not something to say, oh, geez, I was wrong on Redfin and I'm going to sell it now. And, you know, maybe I'll look at it again later. No way. I mean, this company is gaining share. It's growing. I mean, this is exactly the type of stuff I live for. Redfin, I've called it this for long, and I'm not way below. I am below my cost on this, but I'm not way below my cost. I mean, probably own most of this around $20, and I have bought some cheaper. But the bottom line is, you know, this company, I believe, will be a way bigger company. Now, does that mean it'll be a $10 billion company? My market cap's only $1.5 billion, by the way. But will it be 10 billion? Will it be 15? Will it be 30? I don't know. But I just think this company will be a much, much bigger company in multiple years. And we'll see what happens. But I think if you got even a lukewarm real estate market, I think this thing would pretty comfortably trade to where it was before, which would be roughly a double from where it is here. But, you know, it will, I mean, the real estate market is a growth market long term. You know, we're going to build more houses every year. With U.S. population growth, we're going to probably sell more houses most years. But you know, they kind of hit the market at a time when, again, the perfect time for Redfin to come public, and I don't even know if they had a private business back then. You know, would have been 2010 probably. If they were, that was probably around the time they formed. I don't know. I'd have to go look. I don't know the total history of when the genesis of the company privately was, but. They kind of came public at a time when, hey, we've had quite a few years of housing expansion, housing recovery, a big healing up in housing prices. And again, you know, when the Fed raises interest rates almost 2 full percentage points in a year to year and a half, that's going to slow things down. But again, those are short-term cyclical things. You know, I don't know if this is going to be a great year for Redfin. I think it could be a real good year. But yeah, I think over time this is a market share gainer, and those kind of companies tend to. That Workday has just gained a lot of market share. It's really fueled its growth rate over time. Splunk's gained a ton of market share. ServiceNow would be another name I used to like a lot. I used to own ServiceNow. Don't anymore. I think it's expensive. I think a lot of the growth's basically sort of tapped out. But it was a hell of a name for a half a decade or so. And you know, like I said, I think Redfin's about as close as I can come to finding names like Splunk, Workday, ServiceNow of the 2013 timeframe.
All right, so you're adding to this one. They don't have their earnings announcement almost for another month. Looks like February 21st. Well, I'm kind of popping
this for a trade. They got downgraded by D.A. Davidson. D.A. Davidson does some pretty good work sometimes, but you know, as readers know, I don't really care. I mean, I do my own thing. A lot of times I'll use upgrades and downgrades by analysts contrarianly for trades. So, you know, if there's a big upgrade on a name I like, which I have good gains in, and it pops it, I might sell into that upgrade. Likewise, if there's a downgrade on a name. And again, I mean, I just kind of thought, you know, I think when I was buying it was around 9% down. I was just like, okay, you know, 9% down, that's quite a bit. Again, the stock had a big move. I mean, 14 to 19 or 14 to 18 and change is not immaterial. But again, that's kind of what, to me, it's kind of what it should have done. That's about typical, by the way, of the gain in a lot of the stocks that I own and cover. You know, it's basically pretty much most small and mid-cap stocks have moved 20 to 40% off of lows. So their move was pretty typical for the group move. And, you know, so this is just a downgrade, and I just kind of think I mean, they might have some decent reasons short-term to downgrade. I'm not too worried about it. I think the downgrade, you know, hey, if somebody's going to puke up Redfin at 9, 10%, I'll try it for a trade. Might not make money in this trade, but I think I will. And you know, I definitely have a very high conviction this stock is a much higher stock in, you know, 6, 12, 18 months or longer.
Okay, and I don't think overstock is necessarily just a trade, is it? Overstock is more of a core position, right?
No, I'm looking at adding to this, and this was, you know, I hit this name again for some of the longtime readers will be boring. This is old news, but I hit this name before they had their big move a couple of years ago. So, you know, and I'm looking at adding to this. I mean, they've got some short-term blockchain catalysts right now. But really, the stock is just kind of back to that really distressed price point. This is about where the price it was, I want to say, in 2016, 17, where I liked it. Again, I sort of value overstock, like just absolute worst case, to like 30, 35. And quite a bit higher, actually. But, I mean, just like that's kind of worst case. That's what I kind of think core overstock.com plus a relatively menial, you know, valuation on their blockchain assets would be, you know, 30, 35 bucks. You can get to a much higher market value than that. But yeah, I mean, at this price, you put it this way, at this price, you're either getting, you know, the old core overstock for completely free, or you're getting all of the blockchain assets for completely free, or maybe even some of one of the businesses and one of the others for completely free. So, you know, I could basically value that at 15. You're getting part of overstock for free and all of the blockchain assets for free, because it just that's a crazy stock. It's a wild trader. I mean, look at it. You know, it probably shouldn't have been 15 in 2016, but definitely shouldn't have been 88 in you know, early 18 or late 17. You know, the answer is probably somewhere in the middle. You know, I think I don't even remember where I got out of this, but I think I made about 2.5 to 3 times my money on this from my first long. So what would that have been? You know, somewhere in the neighborhood of 32 to 40. I think I was gone. So you know, I was the genius who made pretty good money on this and then missed another double, right? Or more than another double. But you know, that's what I do. I buy stuff when it's cheap, and I usually sell it before everybody gets on the bandwagon. But no, I think this is pretty attractive, and I just think there's some near-term catalysts. I just haven't decided. To be honest, I wish the options were cheaper. But I've been looking at some spreads. The spreads cheapen the structure up a lot. You know, when we get into some esoteric option combos, but I'll probably do some kind of option combo on it to give me some good leverage to the upside, but not pay, you know, like what it would cost to pay for just raw call options at a discrete price. So I'll probably do some kind of spread and cheapen it up a lot.
And how
That's
far?
kind of what I'm leaning towards right now.
How far out would you be
it's
looking at
easy. I'm either looking at Marches or Junes, or maybe do a little of each. I don't know. I haven't decided, but yeah, maybe the smart thing to do is do partial March and then partial Junes. Right now, though, I don't know. I'm kind of leaning towards Marches, because I think if what I think happens, I think we're going to have some pretty decent catalysts between now and March. And so, you know, I'll probably try the Marches first and then go from there. But I haven't done anything yet. I'm looking. I haven't decided what spread structure I'm going to do yet. But, you know, I'm kind of leaning. Plus, you know, a lot of times you get a sell-off like this, as you've seen. You know me. Sometimes I'm not the one. Again, the Redfin was kind of a special deal because it caught that. If Redfin was down just on what it's down today and there was no downgrade, I wouldn't have added at all. So, in other words, if it was just down kind of on the market sell-off, I'd have left it alone. But I kind of like that D.A. Davidson downgraded, and I kind of think that could give me a little bit of a pop in coming hours to days. So with Overstock, though, it's not really down much. It was down a little bit this morning. It's been green part of the day. You know, I'm not so sure this is just a one-day sell-off. So you know, I'm just going to kind of watch it, and I wouldn't be surprised if you know, we have a 4-day week this week. I won't be surprised if 2 to 3 of the days this week are down. So maybe you get another day or two like this. I might kind of get a little more interested in Overstock.
I'm trying.
But it's definitely on the radar, and I'm pretty close. I almost bought it this morning. I just decided not to do it.
Really surprised looking at the next earnings date. It's not till March 14th on this one. It's unconfirmed, so I'm not sure if they have another one.
Yeah, that seems kind of late. I'd have to go back and see when they last reported. They do kind of report off cycle though, so that could be right. But I don't know. I don't remember them reporting on December 15th. I'd have to go back and look.
Yeah.
That doesn't ring a bell. It doesn't ring a bell that they reported on December 15th. So I don't know. I have to look at that. But I would think they more report in the middle of February. That's just a guess.
Yeah, I would have thought so too.
But I mean, here's the thing with this one too. Without getting too off the topic. I mean, to me, this is pretty simple. It's like, look, sometimes you just got to line something up for the risk reward. I don't think there's a ton of risk now in this. Like from here. Okay, it could just be a loser. You know, it could just not work and just sit here. But I don't really think I don't think it's going to get cut in half again. And if it does pop, I think the pop's pretty good. Like there's a lot of people thinking, oh, this thing can go to 1850 or 19 or 20. I'm like, well, that isn't what it usually does. I mean, so in other words, if this thing's going to go, I think it's going to go a lot higher than 20. Now I don't know. I don't know if it's 30 or 40 or 50 or 28. But I don't think it kind of magically stops at 1950 or 20. So that's the other thing I like is that you know, sometimes you line something up. Maybe it's not the greatest name. I'm not, you know, I don't view Overstock like a Redfin or a Qualcomm or a Skyworks or a Twitter. But right here, right now, if it does work, I think the upside's pretty big. So I just a guess, I'd kind of think 25 to 30. Like if they get a good sticky move to the upside, I would think 25-30 is sort of the minimum move.
All right, you ready?
But you have to take a chance it won't work. You have to take a chance it doesn't work. But that's the kind of trades I like. It's not so much that everyone has to work, but when they work, they pay off big. And so if your losses are relatively minor, but when you get a payoff and it's a big payoff, that pays for a lot of trades, right? So that's kind of how I like to set it up.
All right, ready for some listener questions?
Sure.
All right, so got a couple of listeners asking if you have pulled the trigger on the VEEV short, Viva Systems, VEEV.
I haven't. I'm looking. I'm kind of watching. I guess I could have on Friday. You know, like I said, I just kind of, as much as I think we are due for a sell-off and we're due for some short-term consolidation, and again, what maybe we go down a few percent. I also don't really. I don't think that we've seen a capper to the upside. Here, let me pull up. I think what I was looking at on the Nasdaq was something about I was kind of looking for something a good, you know, about 400 points higher from where we are right now. So something closer to 7,500 at a minimum. Nothing says we can't go to nice, juicy, fresh highs, you know, in the first 6 months of this year either. But yeah, there's something that kind of holding me off. And in other words, I could put some shorts on and then trade out of them in a very short period of time. But I'd probably rather do them at higher prices, and that's kind of where I'm leaning right now. And then, you know, as we head into earnings season, one thing I like to do is my focus kind of goes away from indices or the market in general into companies. And I might do a bunch of earnings trades this quarter, and so focus on that. And the interesting thing about earnings trades is that sometimes you can have really good stock that does great even if the market's not acting well. Likewise, a short might do great even if the market's going up a lot. So I'm kind of more in the mode of keeping my capital to attack, you know, quite a few earnings trades and earnings setups. As opposed to, you know, in other words, my last big call was the market was going to go a lot higher, and we're going to have the mother of all January effects, and I positioned for it. So right now I'm basically riding that broad call, and my next mode is going to be moving into more trading earnings and earnings catalysts and things like that. And I'll probably kind of de-emphasize the macro calls and more emphasize, you know, earnings calls on specific stocks. It doesn't mean I'm going to ignore the macro. It just means that, you know, I'm probably going to deploy more trading capital to catalysts. But yeah, I mean, if what I think happens during earnings season, that there's going to be a lot more good reports than bad reports, then I think stocks generally will ebb higher. I think I'll basically get a better chance of shorting the overvalued names higher. And then that's kind of what I'm looking for, is getting them at the highest prices possible.
All right, so you actually helped me segue into the next one, speaking of your mother of all January effects. So here's the here is the statement. It says, I need to challenge this whole mother of all January effects thesis. Really, the only name that worked so far was Spotify, S-P-O-T. Goes on, Qualcomm, CLDR, and Carbon Black.
Qualcomm, yeah, well, Qualcomm wasn't part of the, that wasn't a January effect name, but anyway, keep going.
Yeah, it said those have not gotten anywhere near the levels that TECHT recommended them. So, defend your position.
Yeah, well, I mean, it's not over. I mean, those names aren't over. When I talked about a January effect specifically, I don't know, I think the evidence is much greater on my side if you look at how stocks have traded, you know, off of either the November 20 or the December 24th low. So, I mean, you know, you just pull up 500 charts and, you know, 85–90% of them are going to show pretty good burst higher. It doesn't mean every name's going to work. I mean, it's impossible to have every name work. So, I mean, there's no world that I've ever lived in that every name works.
All right, well, let's follow up on Qualcomm because you had another one. And this one, Qualcomm has taken folks for a ride to the downside since recommending calls. The stock trades so poorly. Can we get an update? It was not brought up on the last call that we had last week. So let's talk about Qualcomm a little bit and where you see this one.
Yeah, well, it's a very, very cheap company. They're currently battling the FTC. So it kind of makes sense that nothing's happening with this because I think everybody's kind of looking for a silver bullet. I think they're looking for there's going to be a court decision. There's going to be some grand settlement with Apple. And you know, my view of Qualcomm is I'm not in it for the short term. And by the way, that's been very well stated. I'm in Qualcomm for the long term, and I think that, you know, we'll have to see how the next few quarters play out. My calls are June's on this, by the way, so we're a long ways from June. And you know, from when I first my big first tout on the stock was around 51 to 53, and it went to 75. So this worked pretty darn well. Went up 50%. Now it went back to basically kind of my entry points, and I'm kind of adding to longs again. But yeah, no, I mean, this would be pretty much my favorite large cap tech stock right now. Period. So I basically view Qualcomm today as almost essentially identically to how I viewed Apple in 2013. I could be wrong. Again, not every name's going to work, but I think there's a very high probability that the name works. You know, I like it for cash flow generation. I like it for the dividend yield. And I don't really care about dividend yields, but if I'm going to get paid a decent dividend yield while I wait, that's fine. But yeah, I kind of just think, I mean, I would almost say the more frustration that boils up on Qualcomm in the near term, the better. Because that probably sets up maybe, you know, an even bigger upside move in the future. But yeah, no, I think just good solid earnings, good solid cash flow production, and this name probably grinds up nicely, you know, over the next coming quarters. The only risk here is if something really crazy happens. Something really crazy would be that if the powers that be decided that Qualcomm is getting paid 50% too much for their IP or something like that. You know, I think that while a possibility is a pretty low probability event, I think a lot of that's priced in. If they lost 50% of their IP revenues, then obviously that's not all priced in. But I think a lot of bad news is already priced into Qualcomm. So again, I like it. I could kind of, I don't really care that the stock, in fact, I like the fact that Qualcomm's not going up right now. Because there really shouldn't be. I would almost be worried if the stock had made a big move with the January effect. One, it's not a small mid-cap name. So large cap stocks don't tend to really be January effect stocks. Two, they do have the FTC case going on. So it would be odd if there was any super bullish trading on the name until you get you know, some kind of a news or decision on that case. But I think this question's a really good example too of, I think there's just too much fear about a company that's actually a really steady, sort of boring, plodding company, which could get a lot more exciting with 5G, by the way. That's the whole the whole growth thesis is all around 5G. It's not around the court settlement. So, you know, we'll see what happens. I'm not one bit concerned about Qualcomm, but you know, I also am not going to put 100% of my money in it. I wouldn't do that with any name.
All right, another one. I'm not sure if it's exactly.
Let me remind. I mean, the same sentiment that you hear about Qualcomm now is very similar to what I used to hear on Apple in 2013. Tim Cook's terrible CEO. God, I wish Steve Jobs was back. Apple, they have zero innovation. I used to battle that argument. I would still battle that argument too. Apple's extremely innovative. You know, there's just all this pervasive negativity on the stock that was trading at 4 times cash. And you know what happened, right? You know, the history is pretty clear. I wouldn't say Qualcomm's quite as easy, but I think it's pretty close. I think it's pretty close. Remember too, you know, we aren't really into the 5G cycle. We have reports of 5G. We definitely have some small incremental 5G sales going on. We have some companies starting to talk about 5G as it's starting to move the needle a little tiny bit. But you know, the 5G cycle, the 5G spending cycle is really a back half of 2019, and then really more of a 2020 to 2021, 2022 story. So, you know, I think what the other thing, maybe, you know, if you're buying Qualcomm, and I think a lot of people bought Qualcomm at 68, 70, 74 in anticipation of 5G, well, they were 3 quarters early, right? So you can't thread the needle exactly precisely, but, you know, I think 5G should start ramping and ramp continuously, I would kind of say, for the next 6 to 8 quarters. But yeah, discrete 5G revenues right now are pretty small. Anyway, go on.
Yeah, and I've more recently seen more and more advertisements on TV and whatnot for 5G. So yeah, you can see it being sprinkled in a little bit.
Oh, it's sprinkled. I mean, we don't even have. I don't even know. There might not be more than one 5G enabled handset right now. AT&T is just doing 5G experiments in a couple places across the country. Same thing with Verizon. But it's getting there. It's getting close. It's coming close to being the lights being turned on for 5G. But again, this is going to be a very long. I think a lot of people try to gear something and say, "Oh man, this is going to be a huge 6-month move." No, this 5G is going to probably be more of a kind of a plodding 3 to 5 year move than an explosive 6-month move.
All right, another one has indicated, and I'm not sure if this one is directed specifically at you, but I'm going to ask it anyway because it's one of the names that you've talked about in the past, and that's FireEye. It says, seems like it has fallen off the radar. Do you still like this?
I like it fundamentally. I haven't done anything on FireEye in a long time. I haven't really traded it. I hold a core position in it. Relative to peers, it's really, really cheap. Sometimes we see stocks. I mean, I wouldn't say this is one of my featured names. It probably is in my focus list, which is 20 names. But I haven't emphasized this name I've talked about. I do like it. I think it's very undervalued. I mean, I can easily value this name to kind of 28 to 30 bucks. Here's what I hope doesn't happen, and I think it's kind of leaning this way. They're probably going to end up getting bought out. If I would say if the stock doesn't react decently to continuing good quarters, that's really been the problem. By the way, the problem is they've delivered. If you'd have told, I think we had this topic. If you'd have told me ahead of last year what the 4 quarterly reports for FireEye were going to be, and then you said, okay, at the end of next year, where's the stock going to be based on those 4 reports? I'd have said, oh wow, yeah, we probably got a double. Stock's probably 25, 30 bucks. Well, the stock's basically flat year on year. Now, it did get a little bit higher, but they didn't really do anything wrong. Company reported well. For whatever reason, it's just some names trade poorly. And, FireEye's right now trading poorly. It doesn't mean it's going to trade. But, Fortinet used to trade like this for years. NVIDIA used to trade like this for years. NVIDIA traded poorly for most of the time that I followed NVIDIA until just the last 2-3 years. Everything kind of came together for them. Once stocks get out of a hatred mode and go into a new money, MOMO mode, very strange things to the upside can happen. But FEYE just needs something like that. I don't know if the company needs to be more promotional about their success. I don't know if they need to, you know, maybe some new blood in. You know, but I'm afraid. Here's what I'm afraid. I'm afraid the company's going to get taken out. And I do have quite a few names get taken out over time. I wouldn't be surprised if FEYE finally succumbs, because people frustrated, shareholder base is frustrated. There'd be a lot of people be pretty happy with the $25, $26 buyout. I hope it doesn't happen because I think the stock can actually trade quite a bit higher than that. But the way it's acting almost kind of looks like somebody's trying to engineer a buyout in kind of the mid-20s. So, you know, we'll see what happens. I hope it doesn't happen, but you know, so they need to get more positive stock action on their good reports. That's something that has been missing. And again, sometimes, I mean, stocks are weird. they're just weird, you know. So, some stocks that don't even have the highest growth trade crazily positive, and other stocks which report really well can trade pretty poor for quite some time. Usually, again, not every time, but the vast majority of the time, if a company keeps executing, growth keeps occurring, fundamental improvement keeps happening, the stock rectifies and trades closer to its peer group. You know, FEYE trades at something like a crazy, crazy discount to almost all of its security peers. So, in fact, the stock, I think the number I use is that the stock could basically double and would still trade at a discount to, I think, about 70% of the names in the security space. So, I mean, that just tells you how cheap it is. That doesn't mean it's going to go up, though. You know, there's no such thing as a sure thing. But, you know, I would say, hey, there's probably 80% chance the stock moves materially higher. Probably 20% chance it doesn't do anything over the next year. I mean, I'll take those out. That's why I keep holding it. You know, otherwise I'd scrub the name. Otherwise I'd sell it and I'd buy something else, because there's plenty of names I like, which have worked very well. So, but yeah, no, I want, you know, I guess I need to see, this is one of those cases where I need to see the stock show me something before I add to it or trade. Or really what I'd like to see, I just want to see more volatility in the name. A stock that gives me more chances to trade it, I'm more active in it. If a stock's really dull and it doesn't give me very many chances to trade it, my activity is going to move towards other names.
All right, I know I'm opening up a can of worms with this one, but a listener wants to know your long and short-term outlook on Tesla.
Well, I don't think it's a can of worms. I've been pretty consistent on Tesla. Tesla's kind of been, I've been more on the bear side of Tesla. You know, Tesla's kind of a funny name too. I mean, for as much enthusiasm as the stock has had, hasn't really done much. I don't think the stock's gone up much since, I don't know, what were the highs in 2014? I'm gonna look right now. 2014 high 290 roughly. Well, it's 300 today. You know, I mean, so it makes big moves higher and lower, but it doesn't really do anything. But I'm more bearish. I think short term, you know, it's actually, I mean, it's had a pretty good knock lower. Any piece of good news, you probably get a short term little burst to the upside. Although, let's just line this up technically. You know, it doesn't have a whole lot of short-term support below 295. So, I don't know, maybe short and long-term, I think a move lower is probably in the cards. But I tell you what, if it gets down around that 250 to 265 area, and they have any good news at all, you know, it would be nothing for the stock to bounce, you know, 40 to 80 points. You know, this is why a while ago I recommended some put flyers, like buy some 250. Now this is when the stock was, I think, closer to 400. I said, hey, you know, try maybe some 200s or some 250s or some 280 puts, which would have been really cheap at the time. Would be a good way to play it, and that would probably be the way I'd play it now. So risk a small amount of money for a potentially big move. But yeah, I'm not doing much on this one. It's kind of weird. I mean, the one thing I will say, though, I have no idea how the stock hangs on to the price level it's at, given the uncertainty of the company. Because generally, when you have high uncertainty, you have a very low price. So this is one of the few names where the bullish cult is so powerful that they can hold the stock up, you know, with a massive amount of uncertainty and a lot of pessimism too. I mean, it's just weird. This is one stock, it just doesn't trade in my mind rationally. I mean, maybe what needs to happen with Tesla eventually is they start producing earnings more consistently. People see what that earnings number is and apply more of like a kind of even a tech PE to it. The stock ain't going to trade at 300 or 400. You know, even if you give them a relatively high PE valuation ratio, you know, on fair to mediocre earnings results, I don't know, let's say they do, I don't know, you know, $4 in earnings. Okay, give them a 40 PE. That only gets you to $160 stock, and that's not a cheap PE. So I don't know. We'll see. Here's the one thing I've wondered on the stock for months now. If they were 2 weeks away from insolvency, and that's per Musk on a 60 Minutes interview. So if they were, you know, 2 weeks away from insolvency, and then they build some tents and they build a bunch more cars in a short period of time, you know, how does that kind of magically fix all the series of a problems that was? So it just, to me, it just doesn't add up. And so there's no way I'm going to be long the stock. And you know, I've thought about shorting. I haven't really done much on the name for quite some time. But yeah, I don't see much bullish on the name at current prices. And I mean, the fact that it's held that 300 plus level, or really 250 plus level for relatively 4 years is pretty stupefying, if you ask me.
All right.
It's almost the opposite of FireEye. As kind of weird as it is that FireEye hasn't gotten anything out of good reports, I guess it's kind of equally weird that Tesla is able to hang on to such a high price with as much uncertainty as bad news as they've had. It's kind of it basically is a very equal thing on opposite ends of the spectrum. So anyway.
Yeah, definitely very interesting, and I can see what you're talking about, just comparing the two charts and how they've traded the last, at least the last year or so. All right, so we do have WDC that's on the docket later on this week. You had talked about that one as a potential name that could benefit from being oversold, earnings estimates somewhat baked in to the downside already, and therefore maybe we've already seen the low in WDC. Still thinking that way, and are you looking at a particular trade for that one? Yeah, well,
I'm pretty sure I posted, I added that at 35.
Was it
that
35?
Was on the 17th.
Okay.
Yeah, that was on the 17th. So, you know, this would be one where I almost hope to have a disaster, like a report that everybody thinks is a disaster. Because I don't have a full position in this yet. I maybe have, it's more than a third, probably not quite a half my position. I'd like to build this to a full position. Possibly could end up overweighting this name. I think this is... I think this is an easy double. That this might even be a triple plus. I mean, you know, stock traded to 110 mid last year without a whole lot of difficulty. I didn't like it there. I think you remember. I mean, it was one of the many names I said, you know, could have been shortable. So didn't like it. Didn't endorse it. Didn't short it personally. I think I recommended shorting. I did short Micron. Which is basically a sister company, sister trade. So, and by the way, I kind of bullish on Micron here. I like Western Digital better, though. You know, one thing I don't think people realize, so as much as Qualcomm is a direct 5G play, I would say Western Digital and Micron are indirect 5G plays and very strong 5G plays. And I'm not going to, this is not, you know, people can go read this, but do whatever research you want on 5G. But the simple answer is, if you just look at how much more memory, so everything from, again, NAND, flash, DRAM, SSDs, you know, hard HDDs, whatever, if you look at total memory usage and consumption and support needed for each of the evolutions of network upgrades, it's not like a doubling of memory. I don't know the number. I used to know this, but it might be something like 3.5 to 5x more memory needed. So in other words, and that tends to be an accelerating thing. So the difference of memory needed from 2G to 3G, let's say that was 2.5x. So then 3G to 4G, that might have been 5x. Well, maybe 4G to 5G is 6, 7, 10x. So what happens is you just have so many more applications that are data hogs because you're transmitting so much more data. And then it's not so much that you just need to transmit and store more data. What is everybody in the world now doing with data? They don't just let it sit there and use it once in a while. They're analyzing it all the time. In fact, they might have machines on perpetual analysis mode doing AI analytics on it, business intelligence analytics on it. That by the way, that in and of itself creates lots more data transmission, on and on and on. But you know, think about gaming, think about AR, think about VR, think about 4K media. I could go on and on and on. But once you have true 5G capability into the hands of, let's say, a quarter of the world's population, I mean, you're going to need a hell of a lot more memory, and in all forms. You're going to need memory at the device layer. You're going to need, you're going to need way more memory at the PC system layer. You're going to be hugely more memory in the cloud, data center. So everything that the cloud runs on is going to have to be massively upgraded with loads more memory and capacity. Western Digital is in the game, and they're in all facets of the game. Micron, and Western Digital are actually kind of probably two of my favorite tertiary 5G plays. Again, very long tail. Not going to be a big burst in any one quarter. Not going to be a big 2-quarter burst. Probably going to be a pretty good 2-year burst. Now, what they're battling is near-term just outright ugliness in Apple device sales. And that's a big buyer. And it's also a big peripheral buyer. So the Apple buyers tend to be big peripheral buyers of storage as well. So, we probably don't get clarity on the Apple deal. We talked about this our last call for about another year. In the meantime, though, I think you're going to start seeing Android sales accelerating pretty nicely. So, but that's just the device front. There's a lot more going on with solid-state drives, in commercial HDDs, commercial class storage solutions, all that kind of stuff. So I think that, I put it this way, I think the best way I can say, I think the down cycle is going to be fairly short-lived. Prior down cycles for memory have been pretty prolonged. Like they're usually a good 6 to 8 quarters, year and a half, 2 years. Look at the last time Micron went from 35 to 10, and then how long it took to go from 10, 14, and finally break out and go to 45 to 65. It took quite a while. Well, Micron's last quarter it was bad, but it wasn't as dire as the worst fears were, and the stock's reacted pretty well since. In fact, Micron hasn't really gone down on that last report. I kind of think Western Digital might set up the same, so we'll see. But yeah, this is one I'm I'd love to buy more of this, under 35. But I don't know if I'll get the chance. That's why I bought some. And we'll see. I mean, here's just an easy number. The 2016 low was 30. I want to say it was 36. Maybe it was a little lower. 2016 low looks to be about 35 on Western Digital. So isn't it interesting that here we are. I think the business fundamentals for Western Digital now are better than they were then. And the stock actually hit the December 24th low was a lower low than the 2016 low. By the way, on a long-term chart, that looks like a pretty good double bottom too. So we'll see what happens. I'm not too worried. Again, I'd relish the ability to buy more of this at 28 or 27 or 30 or something. I'm not so sure it's going to give it to me though. And again, I mean, the stock's still cheap, but I mean, I'll probably be buying more of the stock at 42 and 45 and 50 because I think it's got very notable upside. But yeah, no, I like it. It's probably one of my key names. It's not in my focus list yet, but I'm going to prepare a new one of those probably in the next few days. It's very likely to be. Oh, by the way, it might have been in my last focus list. Put it this way: if it wasn't in my last focus list, it'll probably be in the next one. So, because I'm pretty sure I'm gonna, if I haven't already, I'm gonna swap it for an old name that has already appreciated a lot, and I'm not doing anything on it anymore.
All right, my friend. Well, why don't we leave it there, because I'll probably have you on, I forget what the exact schedule is, but I know if nothing else early next week, if not later this week, and we'll certainly put this one on the agenda to see how it responded after earnings and if you have any new takeaways or updates following the earnings call and what have you. So with that said, Sean, as always, good stuff, and thank you so much for joining us today.
Hey, take care. Have a good one. Hey, and everybody that's new, delve into the platform. Read as much as you can. Excuse me. Make sure you have the dual in-play feature running. That's under the first tab under Briefing Trader, dual in-play. I couldn't use Briefing Trader platform myself if I didn't have the dual in-play. So, you know, that's a tip I'll give everybody before I leave.
All right, and we even got a pro tip on how to use the briefing in play from TechTrader. My man, thank you so much.
All right, take care.
All right.
Later.